The Nasdaq-100 Index, with the ticker symbol NDX, is a prominent stock market index that tracks the performance of 100 of the largest domestic and international non-financial companies listed on the Nasdaq stock market. It was launched on the 31st of January 1985, and it serves as a key benchmark for large-cap growth stocks, emphasizing sectors like technology, consumer services, biotechnology, and healthcare. Unlike the broader Nasdaq Composite, which includes over 3,000 stocks and spans all sectors, the Nasdaq-100 excludes financial companies entirely and focuses on innovative, high-growth firms. This makes it a purer play on the new economy and technological advancement. The index is modified market capitalization weighted, meaning larger companies have greater influence, but with special rules to cap the dominance of any single stock and promote diversification. For instance, no single company can exceed 24% of the index weight, and the aggregate weight of stocks, over 4.5%, is limited to 48%. This methodology was introduced in 1998 to reduce concentration risk while still reflecting market leadership. The Nasdaq-100 is rebalanced annually in December, with quarterly reviews for eligibility. Companies must meet strict criteria, including exclusive Nasdaq listing with exceptions, minimum market capitalization, and sufficient trading volume. As of late 2025, the index remains heavily tilted toward technology, with sectors like information technology comprising around 50 to 60% of the weighting, followed by communication services and consumer discretionary. The Nasdaq-100 differs significantly from the broader Nasdaq Composite. The composite tracks nearly all common stocks on Nasdaq, including financials, smaller companies, and a wider range of sectors, making it more representative of the entire exchange. In contrast, the Nasdaq-100 is narrower, excluding financials and focusing on the largest non-financial firms, which results in higher concentration in mega-cap tech stocks. While the two indices are highly correlated, often around 90 to 95%, the Nasdaq-100 tends to be more volatile and offer greater upside in growth-driven markets due to its emphasis on innovation leaders. The Nasdaq-100's composition highlights its tech-heavy nature. As of late 2025, the top holdings include mega-cap giants such as Nvidia, Apple, Microsoft, Amazon, Meta Platforms, Alphabet, Broadcom, and Tesla. These Magnificent Seven stocks often account for a substantial portion of the index's weighting, typically over 50% combined, driving much of its performance. Other notable sectors include biotechnology with companies like Amgen and consumer services with firms like Costco and PepsiCo. The index also includes international companies like ASML from the Netherlands and Spotify from Sweden, adding global exposure. This concentration makes the Nasdaq-100 highly sensitive to trends in AI, cloud computing, semiconductors, and digital services. Beyond the top tier, the index features a diverse array of companies such as Adobe, Analog Devices, Gilead Sciences, and PDD Holdings, which contribute to its representation of cutting-edge industries like software, pharmaceuticals, and e-commerce. For example, companies like Palantir Technologies and Warner Bros. Discovery have emerged as top performers in 2025, showcasing the index's ability to capture rising stars in data analytics and media. Additionally, newcomers like Ferrovial, an infrastructure giant, joined the index in 2025, reflecting its evolution to include under-the-radar stocks that have shown remarkable growth, such as a surge of over 60% year-to-date. Over time, the index has seen significant turnover. As of October 2025, 526 companies have been components since its inception, but only a handful like Apple, Costco, Intel, and Microsoft have remained consistent through mergers and growth. This dynamic composition ensures the Nasdaq-100 continually adapts to emerging trends such as the inclusion of AI-focused firms in recent years. The sector breakdown as of mid-2025 shows technology dominating at approximately 64.03%, consumer discretionary at 18.29%, healthcare at 4.21%, telecommunications at 3.71%, industrials at 3.66%, and consumer staples at 2.39%, with smaller allocations to other areas. This allocation underscores the index's focus on high-growth sectors while maintaining some diversification beyond pure tech. The Nasdaq-100 began with a base value adjusted over time, resetting in 1994 to 125 after strong gains. It experienced explosive growth during the dot-com era, peaking near 4,800 inches, 2,000 before crashing over 80% in the bust. Recovery was strong post-2009, fueled by tech giants. Key milestones include surpassing 1,000 inches, the early 1,990 seconds, reaching all-time highs in the 2010 seconds and 2020 seconds amid AI and cloud booms, and in 2025 achieving new records, trading around 25,300 to 25,800 levels by December, reflecting continued AI enthusiasm despite early-year volatility from spending concerns and economic uncertainties. From 1,985 to 2,025, the index has delivered robust compounded annual growth, though with significant volatility, including sharp drawdowns in 2000 to 2002, 2008, and 2022. Annual returns since 1986 have averaged around 14%, with standout years like 1,999's 101.9% gain during the internet boom and more recent surges, such as 43.6% in 2023, driven by post-pandemic recovery and AI hype. Between 2007 and 2025, the index posted positive returns in 67% of months, with its best monthly gain of 16.1% in April 2020, amid stimulus measures and remote work shifts. In 2025 specifically, the index saw a monthly performance that included a 9.13% rise in May and a 6.34% increase in June, contributing to a year-to-date gain of approximately 17.5% by September. Before further advances, as of the 20th of December 2025, the Nasdaq-100 has returned around 9.23% year-to-date, though this figure may adjust with final trading days, highlighting a year of solid but moderated growth compared to prior AI-fueled rallies. The Nasdaq-100 has historically outperformed broader indices in bull markets due to its growth focus. In 2024 to 2025, it benefited from AI-driven gains, with strong rebounds after early 2025 dips. Year-to-date, in 2025, it posted solid returns, often leading the S&P 500 during tech rallies, but underperforming during value rotations. Long-term annualized returns, including dividends, have exceeded 15 to 20% in recent decades, though past performance is not indicative of future results. The primary ETF tracking the Nasdaq-100 is Invesco QQQ Trust, known as QQQ, which has seen strong inflows and performance, with 10-year annualized returns around 20% as of late 2025. A lower-cost alternative is Invesco QQQM. The Nasdaq-100's narrower scope amplifies tech exposure, leading to higher potential returns and risks compared to the S&P 500. When comparing the Nasdaq-100 to the S&P 500, the former has shown superior long-term performance, with a 1,308% total return over certain extended periods, versus the S&P 500's 543%, translating to annualized returns of 16.1% versus 11%. In 2025, halfway through the year, the Nasdaq-100 led the S&P 500 with an 8.3% year-to-date return compared to 6.2%, building on a long-term advantage. Over the past 30 years, from 1995 to 2025, the Nasdaq-100 achieved approximately 3,765% returns, far outpacing the S&P 500's 1,033%. This outperformance stems from the Nasdaq-100's heavy weighting in technology and growth stocks, which thrive in innovative environments. Though it comes with higher volatility, standard deviation around 23% versus the S&P 500's 20.1%. In 2025, top performers like Palantir Technologies, Zscaler, and Mercado Libre highlighted the index's strength in cybersecurity and e-commerce, often surpassing broader market gains. Conversely, laggards such as certain biotech firms faced headwinds from regulatory pressures, illustrating the index's sector-specific vulnerabilities. Over the past 2 decades, the Nasdaq-100 has seen a 199% increase in total return compared to the S&P 500, providing unrivaled performance for growth-oriented investors. The Nasdaq-100 symbolizes innovation in AI, semiconductors, cloud, and biotech. It benchmarks tech-focused investments and is widely used in ETFs, futures, and options. Investors favor it for growth exposure, but its concentration risks overexposure to tech downturns, as seen in past bubbles. Diversification with value or broader indices is recommended. As of the 20th of December 2025, the Nasdaq-100 closed at 25,346.18, up 1.31% for the day, reflecting optimism in AI and tech resilience amid interest rate and policy uncertainties. Forecasts for 2026 suggest potential highs toward 27,000 or 30,000 if AI momentum continues, though corrections remain possible. Analysts project the index could reach 25,962.87 by year-end 2026, with further growth to 31,464.47 by 2029, driven by sustained AI adoption and corporate earnings. However, risks include high valuations, policy changes, and economic headwinds, with experts noting that while 2026 could be another positive year for stocks, concentration in a few megacaps remains a concern. Historical patterns indicate the Nasdaq-100 may see significant moves in 2026, potentially bullish if tech resilience holds, as seen in cycles every 5 years. In the broader context, the Nasdaq-100's evolution mirrors the rise of digital transformation, from the internet era to today's AI revolution, making it an essential tool for gauging future economic trends. Its inclusion of non-financial giants ensures it captures the forefront of global innovation, influencing investment strategies worldwide. For risk-averse investors, blending Nasdaq-100 exposure with the more diversified S&P 500 can mitigate volatility while capturing growth. Ultimately, the index's track record of resilience through market cycles underscores its value as a long-term holding for those betting on technological progress. In summary, the Nasdaq-100 captures the essence of modern growth investing. It is innovative, concentrated, and transformative. Its evolution, from a tech-centric index to a global benchmark, underscores the dominance of non-financial innovation in today's markets.